Hello, everyone, and thank you for joining us today on the Dairy Signal. We are all ready for another market update here this afternoon. But before we dive into that, let's take a second to talk about a little bit of today in history, as it's one of those that we can probably all remember from our elementary and middle school days, at least a little bit maybe, as today it was Anne Frank's birthday. And on her 13th birthday on this in 1942, she actually received the diary that would be the iconic start of her family's tale for 2 years in hiding during the experience during World War II. So that is your tidbit for today in history. But I know we have a lot to get to talking about agriculture, market updates, and everything in between. So I'm going to pass it right over to you, Ben, to get us started.
Okay, well, thank you so much. Always a pleasure to be here. And there is, I think we kind of talked about this earlier. There are a million little things going on, but I think big picture wise, not much new from our end. I know that jumping right into it, class three is down, July about $2 a hundred rate from where we were, close to our last meeting. And so, a lot of volatility, and that's all part and parcel of this. Unlike the grains, which we will get into in depth the back half of this, markets that are not terribly well supplied and are historically kind of expensive, you must expect very wide swinging markets. Is there going to be enough butter on November 1st, or is there not? Same thing with whey or cheese. The market perception is going to swing pretty significantly on a weekly, monthly basis. And so that's why I think you've got the volatility in class three. Momentum down, it's very much a momentum driven market. And so having turned the tide a couple of weeks ago, below initial chart-based support, all this is pretty easy to explain and why class three milk is where it is today. I don't think this tells us much about the future of cheese, butter, other product supply and demand, though. So again, at Ag Resource, I'm not terribly concerned about the break. And the silver lining here, or the caveat to this, is we do think feed markets are going to follow milk, and they have followed them lower to the point where maybe philosophically some of the break in class three is a function of the break in feed costs. The market has to work a little less hard to guarantee U.S. milk production growth, I guess, is the idea here from a very big picture. And we are not terribly optimistic on feed costs moving forward. So, and I think it really just comes down to weather patterns and what we've seen. I know it's very early, but it is almost the middle of June. And really nowhere in the world, except for maybe parts of China, maybe parts of the Black Sea region, have seen, I think, real dislocation. And the early yields we're hearing from winter crops are very good from Texas to southern France to northern Italy. So it seems like a lot of the world has avoided the pretty big weather issues that we have seen the last 5 years. So it does seem like feed markets are almost locked into being adequately supplied to maybe oversupplied. And we do have to contend still, this is going to be the theme for the next 3 months at least, pretty decent US milk production growth. So you all know we highlighted this 2 weeks ago, 19.4 billion pounds officially in the month of April, up 1.5% from last year. If we just do our basic arithmetic, looking at the cow herd today, seasonal trends and the change in the cow herd, and I think the big issue, or not issue, but support here is, stabilizing milk yields on the West Coast, kind of having solved avian flu. So most likely we're going to see production growth, in the month of May of, 1%, 1.1%. And that carries through really through the balance of summer. So it's not until maybe September or October that you start to see a little less growth in terms of intensity in U.S. milk production, which may be its own issue when we get there. But for now, I think so cheese processing plants, dairy processors as a whole are going to have access to a lot more milk, and almost nationwide. I don't think there's really any region of the U.S. that's going to have real supply tightness. So, again, that kind of prevents any kind of outlook suggesting $22, $23 class three milk. We're just not in the period where fear comes in or there's really any need to ration available supplies like we have seen the last couple of years. That's not the case. Because even looking at this graphic, you can see part of that fear was driven by just no end, unceasing milk production contraction. And we have at least solved that issue. So again, we are pretty mindful of what's available in the US in terms of surplus raw milk. I think there is upside in the milk market, which is very, very common until you get to about October. But we do want to, unlike the last couple of years, those are opportunities. So we want to be more active forward contracting. And like the seed we have planted the last couple of dairy signals, think about Q1 2026. I mean, that's always going to be the biggest risk. unprofitability has been a theme for a lot of people, Q1 of almost any calendar year. But we can manage that risk as long as we kind of have sold forward as we get into seasonal highs in the milk market, late summer, early autumn. So that's kind of our very clear recommendations is not selling breaks. We are using recoveries to hedge and hedge into the early part of 2026. Product production too, and this is not terribly insightful, but we found if you go back a decade or so, cheese production generally on par with milk production. And so as we have solved the US milk production issues, we are seeing growth in US cheese production. But as we'll touch in a little bit, this is the last number that comes out from USDA. So when we put together the monthly supply and demand of dairy products, this number means very little except for it gives you exactly what demand was during that. And as we will discuss, demand for US products is very, very good. But at the same time, kind of balancing that out is sustained butter production growth. It was up 4% from last year in the month of April at 216 million pounds, and the return of pretty sizable American cheese cheddar production growth. Up 8% in April at 338 million pounds. And again, I think we're dealing with a sustained period of U.S. milk production growth. Probably we will see cheese production follow that, 0.5%, 1% at least minimum, for the next 6 to 8 months in the American cheese market. I also think what's driving sort of class three, and there's this kind of outsized speculative influence on the market, for better or worse, and that changes nothing in terms of what we do, but especially the last 2 years. We have seen not only the spec community participate in the milk markets more actively, but also willing to be short, which makes very little sense to us, but that is the way it's been. And they covered that short position almost exactly and completely as of the final week of May. So that explains $20 class three in the spot market, but also explains why maybe the idea of raw materials, no demand growth to speak of. When we look at the basket of commodities, that includes like grains, oil seeds, maybe crude oil, dairy products would be included in there. So we have this sort of willingness again for the speculator to be short of milk. I think those positions will always be covered, but I think too, explaining the break in class three in recent weeks, it's, they established this very slight long position, all shorts were covered. Now there's kind of room to start selling class three again, at least for the very short term. And also, I think the fundamental issue that we've got, or helps explain maybe the recent break, is we've kind of talked about one of the actual fundamental risks to the U.S. dairy space was, does China exit the U.S. market because of trade tension and actual tariffs, which despite the sort of lengthy, prolonged discussions that trade negotiators on both sides had this week in London, there's still a 55% tariff on goods coming into the US from China, which supposedly is not going to change. And then there still is a 10% tariff on, as we understand it, all US goods going into China. Especially in the month of April, those numbers are very high. At times it was 125% tax on US goods going into China, including ag products. So it doesn't surprise us that China has kind of shunned a lot of the US ag space. And that was the case in April. Not completely, but if we look at total dairy exports to China in the month of April, just 23,000 tons. That's the lowest any month since 2019, and basically kind of rivals what we saw during COVID. Whey exports been very, very fluid, but this is, of course, the dominant market that we focus on when we think about U.S. trade with China, dairy-wise. It's animal feed. They use a lot of whey protein for animal feed. Just 11,000 tons in April, lowest since the winter of 2020. Of course, COVID is what we're rivaling now in terms of Chinese demand. So I think this probably changes. I think the 10% tariff does allow U.S. supplies to be competitive. That 10% tax China implements on U.S. dairy products is not high enough to change trade flows. I think if that's the case, cheese is still cheaper than cheese in New Zealand. Butter, incredibly cheap still, and I think even whey has some kind of advantage from the U.S. into China. But we did want to communicate that China is reacting to trade policy from the U.S., and that's important to note. And I think that's why we're going to continue to see across the ag sector a lot of reactions to headlines, whatever they may be. This week, it seems like we're all kind of ignoring what's happening between the U.S. and China, which makes sense. All we've done the last really 72 hours with those meetings is go back to the deal we had originally established in Geneva several weeks ago. So kind of not a lot of progress, we think. And these things do take weeks, months, and years, so that's to be expected. But again, there's nothing new in the market today. So China is still an issue to us. What will the tax be from China on U.S. ag products going into the country? If tensions get worse, they will leave the U.S. space, and that's kind of what this shows. So expect some volatility with respect to macro and geopolitical headlines. But we are still very competitive, and we found kind of offsetting demand everywhere else. So to me, U.S. dairy export disappearance is still very robust, and we still have, in totality, this newfound share of world trade. Total exports in April, 221,000 tons, down 6,000 from last year. But given the loss of China, I think that's kind of a positive in that, exports to everywhere else are up pretty substantially. I think we still got another 60 days of sort of peak export season, and I think those numbers will be very, very large. And again, we won't know this for a month, but does China come back to the U.S. space? I do think they're, at least in the short term, just that tariffs are sharply reduced does bode well for U.S. dairy going into China. But it's certain markets, it's very product specific where we see what is growing and what is not in terms of U.S. dairy export disappearance. So we like fluid milk and cheese and butter. Gangbusters is how we would determine export disappearance. So fluid milk exports 14 million liters, the highest for any month since July of 2024. Cheese exports 49,000 tons, also a record for the month of April, and just fractionally below that all-time record we saw in March of 2024. And in the case of fluid exports and cream, it was really just kind of traditional buyers really stepping up. But after this kind of post-trade war, so I don't think this is just restocking ahead of potential tariffs, but this kind of encompasses a period that included reciprocal tariffs. So places like Canada, Mexico, and Taiwan just buying sizable amounts of U.S. fluid milk. So we like that. I think, kind of weak price in Q1 have sparked demand is what it's telling us. And then cheese, 49,000 tons. I think it's just telling us there is nowhere else to buy cheese for nearly the cost that you can get it out of the U.S. And we'll kind of look at the snapshot. Every 2 weeks we revisit this, but U.S. cheese is still, 25, 30 cents a pound below everyone else, all competitors. And I think kind of importantly, there's been no real downtrend in export. So usually it's almost clockwork. You can kind of see in these graphics that the seasonal evolution on a monthly basis, but we saw no downtrend, no weakness in the month of April, which was telling. So again, I think we're going to see very, very strong cheese exports confirmed in May and probably above last year for the rest of 2025, just given where the U.S. cheddar market is. And it's places like East Asia, the Caribbean, and of course Mexico, Taiwan, Canada are big partners, just buying U.S. cheese in bulk. So this is working to offset some of the availability of raw milk that is higher year over year, but we're making a lot more disappear. And butter is also pretty special. And again, what we like about these is we can kind of see the world market. So we know that U.S. Products are either expensive or cheap compared to similar prices in South America. Europe, Australia, New Zealand, and today, and has been the case for the last 3 months, U.S. butter, U.S. cheese, sharp discounts to everywhere else, especially in the case of butter, and the market has reacted to that. So we're seeing this response, and that response is ongoing, and I think continues indefinitely. So now we're exporting in outright tonnages, 8,000, 8,500 tons of butter on a monthly basis. That's 3 times where we were last year. Also had net exports in April just under 3,000 tons. And of course, you can see in this graphic kind of the abrupt shift that's happened over the last 6 months. So this is adding to, consumption, 3 to 6 million pounds per month. And thinking about the switch, so a year ago, we were adding 4 to 8 million tons or pounds of butter supplies because of imports. And now that's completely evaporated and we've got a net draw of 3 to 6 million pounds. So we're kind of seeing that play out in an inventory report. So it's not nearly as much butter as we thought we had. And again, the snapshot is U.S. butter is still incredibly competitive in the global market. So I think that when we do this again 6 months from now, we're going to see positive and net butter exports each month throughout summer and into the early part of autumn. Kind of like I mentioned about production that we get from the USDA being the last piece of the puzzle when we look at demand, kind of quantify how much of cheese and butter is being made to disappear at least. And it's very, very strong. So we got American cheese disappearance or consumption in April at 484 million pounds, up 12% from last year, also a record for the month. Jan to April disappearance, despite very weak numbers in February, almost exactly unchanged from last year at just under 2 billion pounds. So we think about this big picture wise, cheese demand in the US, partially because of exports, is very strong. And we've got, I think, still more to go. Clearly, you can see that May is a very big month for exports, or for demand that's come and gone. But also August, October, still to come. So what will milk production, cheese production be then? We know a lot of it's going to disappear. We're just optimistic, and I think demand's been very positive and doesn't change. And butter has just been outright special. So butter disappearance in April, we've got 212 million pounds. That is up 21% from last year, a record for the month. Not terribly far from all-time records for any month. Jan to April, butter disappearance, 790 million pounds. That is up 75 million from last year. So thinking about too, where else would you get butter from, given there is still, almost $1 per pound discount compared to Europe and Oceania in the United States. And this is kind of part of a longer term theme. Just the world's demand for fat is very strong. It's growing no matter the price. And the US will get to participate in this given ongoing production challenges, high prices everywhere else in the world. But we are just making a lot of butter disappear. Butter seasonal trend in consumption too, you can see, is a little more rigid. So we're not even close to peak disappearance yet. It is that September to November period, holidays, sort of return to school, baking, etc. And I think the butter market, like is always the case, but especially the last 3 years, is going to ask itself a lot of questions. What will stocks of butter be on October 1st, on November 1st? What do those stocks cover in terms of days of use? Is there going to be some anxiety getting through the holiday period on behalf of suppliers? And we can't answer those questions now. I think the larger availability of raw milk helps, but just know that butter demand is very strong and, of course, far from peaking. That's still to come, Q3, parts of Q4. And to that end, we kind of talked a lot about, seasonal price trends, seasonal trends in demand. And I think this explains a lot of it. Whether it's corn, wheat, soybeans, crude oil, dairy products, this is all still very much rooted in the physical supply of commodities. So it's been kind of an odd 24 months in cheese, but generally speaking, you peak cheese stocks May, June. Butter stocks always peak May, June. So the market is very weak, Q1, et cetera, because we're in this process of building stocks, and that's guaranteed. The market does not have to work to ration supplies, but rather kind of targeting clearing inventories via some price. That starts to change in the second half of the calendar year, and I think especially thinking about the butter market. Exports going to be very, very large, net positive, again, for probably the rest of 2025, and accelerate this downtrend. So we discussed this 2 weeks ago, but butter stocks being below last year was a shock on April 30th. And so maybe you build stocks by 5 or 10 million pounds, in May, but then June you start to lose them. So that is, I think, what gives us not hope, but I think just kind of putting the fundamental economic picture together. I mean, I don't think the cheese market will have peaked at the end of May. That does not make a lot of sense to us, given physical supply and demand and how that evolves through the calendar year. And that's kind of what we've seen. I mean, we've seen some seasonal price trend charts. Generally speaking, they're positive until October across the board. Butter has often spiked because of the need to ration supplies at some point between September and October. We wanted to show this a little differently this time, just thinking probabilities, and not every year. Thinking about 2022, we were at record prices, and so the market did correct once it happened. And I think that was kind of partially getting into the weeds, going from 0% interest rates to having interest rates exist. It was very bad for the ag sector, raw material sector as a whole. But it's just very common for the cheese market to be at where it is June 1st to probably higher. And so again, I think putting this in perspective, we don't want to chase these wide swings in the marketplace. Butter too. I mean, just since 2016, odds are very, very good. We have not seen the peak price in butter. Summers tend to be very positive. And again, want to communicate, we're using recoveries because of a lot of geopolitical, perhaps weather risks, economic risks. Rallies or recoveries are places to add to forward coverage. But again, breaks are not. We do not want to chase markets lower, I don't think. And part of our big picture outlook and just keeping it as simple as possible, this is where we are today in the world markets. And it looks like it has the last really 3 months. Last week's global dairy auction did feature a correction in cheese prices, about 10 cents a pound. and the butter market was down very fractionally. But when we look at physical cash markets, the same week, that was not the case. So butter in New Zealand and Western Europe built premium. EU butter is back to 380 per pound. US markets kind of hovering around 250 to 255. New Zealand butter still $3.55 a pound. So again, you've got a dollar plus premium as of last week in these competing markets in New Zealand and Europe. And cheese was the same. There was a little bit of a correction in New Zealand. It was down about 5 cents per pound from the previous week, but still at 225 versus the US block market, anywhere, we see it 185 to 190. So again, just kind of extrapolating forward demand, forward exports, I think breaks in the class 3 cheese market are only going to more so guarantee record exports for the next quarter or two. And EU cheddar is 240 per pound. And I think something we're kind of paying a little more attention to are currency relationships, which in the past have been, outright bearish things like corn and soybeans. Just thinking about weak currencies in South America or in Ukraine or Russia, essentially just increases farmer profitability. Things like corn, wheat, soybeans, you could have $9 soybeans and the Brazilian farmer is still profitable because of a weak currency. But in the dairy space, we're competing against New Zealand, of course, but also Europe in a big way. And the euro is flirting with 3-year highs still, and the dollar is not terribly strong. So I think that continues to funnel, especially cheese demand, but to some extent butter demand to the US, just because you're paying so much for it in Europe, and currency is not helping the European exporter by any means. So that's something we'll all kind of start to revisit more as we get deeper into summer with the dairy signals. And kind of our normal aside, the whey market not abundantly supplied. It is very clearly bottomed about 6 weeks ago at 49 cents per pound. It is now at 54 cents per pound, and it's about 10 cents above where it was a year ago. Probably we have begun this ascent to something like 60 or 65 cents a pound in November to December. I just don't think there's much in the way of disrupting this, especially if we can hold on to some measure of Chinese import demand. I think on balance, this does lend support to the class 3 market over the next 6 or 8 months. But the whey market, again, just wanted to show you, it's not abundantly supplied. It's actually getting fairly tight. We are really struggling to match consumption in terms of production on a monthly basis. And so that's going to be difficult to build whey stocks. The whey market probably goes higher and pretty fairly valued where it is today. And I don't know exactly how this plays out, or it probably doesn't play out fast enough to really alter milk production trends, at least for the rest of summer. But the beef market, we've been waiting, or have everyone kind of in the ag space has been concerned that is this the long-term peak, this ultimate, ultra bear market lies ahead. There's just nothing in any data set to suggest that. And I think, we're kind of concerned that this is snowballing upon itself. And, again, like milk, when you have high price markets that are very tightly supplied, volatility is guaranteed. What does it mean if you lose even, 5 or 8% of value in the live cattle market? You're still historically high in terms of price. So be prepared for that. But there does not seem to have been any rationing of beef demand. It seems like those that are eating beef today will eat it no matter the price. I think demand's pretty inelastic. And also we're at record prices across the board, and thinking kind of what happens to beef supplies, cattle herds moving forward. I mean, the on-feed reports have not suggested any measure of expansion. And then to kind of raise cows is very expensive. So, at what point and what does it take? What's going to be the catalyst to building the U.S. beef cattle herd? And it's kind of difficult to know what that is. Partially, beef demand is very high during the summer, so there is going to be a seasonal correction after August. That's almost guaranteed. But higher highs, higher lows does seem to be the feature of the beef market until we see some sign that things are changing in terms of cow numbers, which we don't yet. So I think thinking about dairy cows, I do think we have seen this seasonal expansion of about 50,000 head over the last 4 months, but part of that is seasonal in nature as well. I mean, I think we kind of see and feel dairy herds tend to get larger during the winter and spring months, and they can tend to contract thereafter. There's competition for those cows in the beef market, and that is not going to change. In fact, the competition is kind of the highest it's ever been. So this lingers in the background. Does it kind of act as a weight? Does it keep U.S. milk production growth capped at 0.7, 0.8%. I don't think we're going to see 1.5% anytime soon, at least until the beef market corrects. Fresh news, just about an hour and a half ago, the USDA did release their June WASDE report, and in that report, based on price action to date, it's still above $21 per hundredweight in their all milk cash price. Product markets raised across the board. Whey was the biggest beneficiary. I think their 2025 cash whey price forecast was raised 5 cents per pound. And you can see here the all milk cash price raised 15 cents per hundredweight to 21.30. We don't have any major problem with this. Again, I don't think you have the fear or the outright need to ration supplies to get you to $22, $24 cash prices. But 21, 21 and a half, I think makes pretty good economic sense. And that's probably what we're stuck with for the next several months. Feed markets, again, the sort of silver lining to declining class 3 milk prices, at least recently, is I think feed will be abundantly supplied. And so as analysts, you got to say, price is how you fix that. And the big issue that we've got, and we will touch on a lot of weather patterns, but we don't see any new real demand drivers. So biofuel markets in the US are fairly mature, especially ethanol and even renewable diesel. We don't know exactly what the Trump administration will do in terms of credits or mandated volumes in 2026 onward. I think we'll be debating those, and there are rumors about every 3 hours, but it kind of comes down to gasoline consumption or motor fuel consumption. There's just a cap in that. So you can only use so much in terms of biofuels to be blended into that. And that's the case in most of the developed world. It's China, rather. Does China come back to the U.S. space, but really does China import more grain and soybeans year over year in 2025? That's, I think, what we're left with in terms of feed market demand drivers. And for context, China has still this, as of the end of May, based on trade data, imported virtually no corn this year. We'll have only imported 3 million tons of wheat. Last year, they did 13 or 14 million tons. So China is really importing very little grain and has stagnated its soybean imports. And so that's why the market is so volatile. We're paying so much attention to all of these trade talks, all of these headlines surrounding U.S. and Chinese trade relations. And I've been able to read this for a while, but I think we have exchange. We get some rare earths. They get some of our high-tech chips. That's all we've got. Otherwise, it is back to the Geneva Accords, which I think was just 6 weeks ago. So this is going to take time. I don't think we get something done prior to harvest, which is kind of a big deal given that's where we're going to have the most abundant supplies of all wheat supplies, corn, soybeans, and that's the case in the Northern Hemisphere. So the markets, I think, are going to have to sort out just having a lot more of this stuff. What does that mean? Competition for demand, trying to encourage domestic consumption, things like that. And keeping it very simple, I think a lot of this is just based on weather. I mean, we have avoided a lot of threats. And, as dire as the drought monitor looked at the end of winter, it is almost completely solved at this point. And I know there are regional issues. You kind of see here that drought now just covers 21% of U.S. corn planted area. 3 months ago, it was nearly 50%. And so a lot of white on this paper. So I don't think water availability is an issue for now. So this is kind of the latest and greatest U.S. drought monitor. And on the right, you've got the Weather Service's 7-day forecast. So a lot of Wisconsin, what remains of abnormal dryness probably gets eliminated completely. And that's the same is true for the kind of worst spots in the Corn Belt currently, and that's eastern South Dakota, and of course, almost exactly the political boundaries of Nebraska. But everyone's going to get some water for the next 7 days, except for western Kansas and Oklahoma and western Texas, which they would love dryness because they've got a winter wheat crop to harvest. So it's been very difficult to identify new threats. And jumping kind of further into the weeds here, we work with some row crop producers in the Southeast, in Louisiana, Mississippi, where irrigation is pretty prevalent. But a lot of these guys have yet to turn on the spigots, which is good for them. But a lot of this corn is also in peak pollination currently. I think the Louisiana crop is probably 90% silking right now, and Mississippi is going to reach about 50% silking next week. And here is the 7-day rainfall forecast there. So again, probably, if planting intentions are correct, Texas and the Southeast will produce 100 million bushels of additional corn this year compared to last. So even those, export markets at the Gulf, the poultry markets in the Southeast will have more abundant supplies. And does that kind of change the flow of corn and feed markets, in the Midwest, given that they're going to have a rejuvenation in available supplies? Not all is well everywhere, but this is where NOAA or the Weather Service thinks that soil moisture anomalies will be on June 25th. And so you've got pretty glaring issue at Southwest Iowa, Southeast Nebraska, but everywhere else kind of within the realm of normality. Abundance, South, Southeast, Eastern Midwest, a lot of the Great Lakes region. So we just don't see a problem. And I know there's a lot of growing season to go. Does the summer climate pattern really set up hot, dry the month of July? That still kind of lingers in the background in terms of uncertainty. But we have found that you're kind of by June 20th or so, you kind of know what you got in terms of summer weather. We have done a lot of work digging into NOAA's weather data that goes back to 1895 and just looking at probabilities and at least correlations. So it's going to be a fairly wet June, a June that's defined by no real drought in a lot of the Corn Belt. And so what does that mean for July? And we going back to at least 1950, let's take a look at years in which June was normal rainfall or above normal rainfall. And on the left, you see that broadly speaking, you can't avoid drought, thinking about 2014, 1983 especially, but probability is that you've got a normal to above normal rainfall in the month of July. Soil moisture is a pretty big determiner of temperatures as well. So you've got sort of soil moisture abundance or it is adequate. That seems to, on balance, cap sustained heat. And so that's why you see what you see on the right. Odds are also good. You don't see, extreme heat in the month of July if June is wetter than normal. So anything can happen. Weather forecasts are updated every 6 hours, but just kind of thinking about risks in the supply market. If you're a corn producer or soybean producer, be very prepared to on recoveries in the next week or 10 days. Do something for new crops, some kind of short hedge. Because again, thinking about probabilities, I don't think we're staring in the face of something like 1983, in which it was very wet until it stopped raining and never rained again through the rest of the growing season. That seems to be an outlier to us. And I think you can all see and kind of feel 5-day, 7-day forecasts. Everyone talks about weather being good, bad, non-threatening, et cetera. But we've kind of taken another step in for a long time, and we've shown this on the Dairy Signal. The summer forecasts were unwaveringly hot and dry, just about west of the Mississippi River. So you're kind of targeting the Dakotas, Iowa, Nebraska, most of the Canadian prairies with drought development to the point where the climate guys that we work with, just 2 weeks ago, were sending us pretty alarming emails saying that here it comes, that drought development still on track. But it just keeps raining, and so you get to the 7-day forecast, and it just looks very good. And so even the long-term climate models are kind of adjusting for the replenishment of soil moisture. And so here is we've got NOAA's computer model. This is the July precip probability forecast. And so not all is well. Montana, the Dakotas, maybe the far western Canadian ag belt does look drier than normal, but most of the U.S. corn and soybean belts do look like normal to wetter than normal. So even these maps have changed as we have shrunk the coverage of drought over the last 2 months. And so again, thinking about market risk, that's our primary role here. It is one of abundance come autumn, and that abundance we think could be global in nature. So we've got these default positions, and a lot of this, in the case of corn especially, it's just the U.S. farmer at least intending to plant about 6 million additional acres this year. Maybe some expansion in places like Ontario, Ukraine, and we will see, but in the U.S., getting 6 million additional acres raises the burden on yield if you're going to have supply tightness. So the USDA currently today projects, 612 million tons of production from the US, Brazil, Argentina, and Ukraine in calendar year 2025. And that is up 38 million tons from last year, or about 1.5 billion bushels. And so that by itself, the market's going to do what it does during summer. We're waiting on weather patterns. We're waiting on US-Chinese trade deal news and deals everywhere else, the UK, Europe, India, et cetera. That all is going to give us volatility. The cash markets, again, there's going to be 1.5 billion additional bushels of corn available to the world on, let's say, October 20th. And what does the market have to do? It's got to sort out those supplies one way or another. So if you don't see just rampant import demand growth from China or somewhere, competition for disappearance is going to be the defining feature. And so we're kind of playing around with the risks of even a larger production We just see very good yield results so far in Brazil. Like we talked about U.S. weather, it looks fine. Drought, water availability won't be a problem. Is this the year we kind of cross for sure that 180 bushel per acre threshold? Does that 1.5 billion bushel number get to 1.7 or 1.8 billion bushels? And I think given weather patterns to date, that is at least a risk that we have to entertain. And that's kind of what we're doing in Ag Resource now, is going through scenarios. That's all we can do. We cannot say for certain that the U.S. national corn yield this year won't be 173 or 175. Again, pollination still ahead. We think that happens in bulk in the central U.S. between July 10th and July 17th. Pretty normal, maybe a little earlier than normal. But here's what we've seen over the last several decades. So in fact, the last couple of years, U.S. corn yield has been about exactly trend. Stagnation has been the theme. We have not seen a lot of growth. But I do think we've got to, again, if we're managing risk for both the dairy operation and the corn farmer, yields compared to trends or the discrepancies, 2 to 4% common and in fact should be expected. So that's kind of where we would begin this process. And so the USDA's currently forecast 181 bushel an acre yield is something that's never been done, has been forecast about every year for the last 5 years, but we just cannot seem to cross that threshold. But mathematically, if you add 2% to the mathematical trend, which this year is 182, you do get 186. So it does seem like mathematically there is the risk that you could have kind of a monster corn crop, or you lose 6 bushels an acre of yield. So we go through our balance sheets and we kind of let's play around with what we think is a very wide but the most probable range of U.S. corn yields this year, 175 to 185. And we struggle, and this I think is kind of the high level message. First to the corn producer, again, recoveries, do something. I know there is in the Midwest a lot of downside protection with crop insurance, but we're kind of concerned. I guess that the biggest risk to us is we enter this period of 12 months where market doesn't do anything and tries to encourage demand growth. But it's 96 million acres of corn that we think we've got, and assume yield loss from trend of 4%, 175 bushels an acre. You got to ratchet down your residual use. That's just kind of how the correlation works. But even assuming kind of limited change in demand, you're still left 1.7 billion bushels of end stocks. And so that is not bearish of corn here, but nor is it bullish, especially for the next 3 to 4 months. If yield does get to 185 bushels an acre, I don't think that is the case today, but we'll see what July weather does in terms of Mother Nature's performance. Then you can find demand. You have higher feed use, you have higher exports, and you're still left with 2.3, 2.4 billion bushel in stocks. And so that's, I think, a growing risk. And again, just given that we have avoided drought development at least through June 10th and probably through June 25th. That's just, again, keeping this as simple as possible. Weather has been fine, and that's kind of the high level message. So going further afield, though, I think we're looking at places like key areas of Europe, the Brazilian corn crop this year, the Argentine corn and soybean crops, and even the Black Sea vegetation health isn't showing us much in terms of alarming downward potential. It's been 9 years, and we've seen virtually no growth when we look at all major crops combined and productivity. The USDA currently is forecasting corn, wheat, barley, sorghum, soybeans, and canola yield this year to be 3.96 tons per hectare. And I guess we don't have any real dispute with that. So I think that's, again, kind of a high level risk to the feed markets if you're producing this stuff, is that maybe this is the first year in 9 that we do see what had been normal yield growth, record combined yields. And I think that risk is intact. Again, we'll see what July weather does, but to date, there aren't just many problems on Earth. So I think we're going to be building stocks pretty easily. And that's just thinking about physical cash supply availability on October 15th should be abundant almost across the board. I know wheat is not terribly relevant to feed markets for dairy operations nearly anywhere, but this is also an issue that I think we have to contend with when we think about something like corn. Winter wheat production up year over year despite having lost acres. And the USDA this morning kept their yield, winter wheat yield, unchanged at 53.7 bushels an acre. That is the second highest on record, only second to 2016. So a very, very good crop. Makes sense. Crop conditions have been pretty elevated all season. No moisture issues for most places. And so we're going to have to contend with more wheat in the U.S. this year. Stagnant demand, I think we're going to be building wheat stocks pretty significantly. And the USDA this morning cut their wheat stocks estimate just a little bit by about 27 million bushels, but still 900 million bushel in stocks from USDA. We think it'll be 925, and the reason for that is we basically know what we will have exported in an old crop position, and it is smaller than what the USDA thinks, even if just a little bit. So that will be carried over into new crop supplies. And also, I don't think the USDA has really quite got access to winter wheat yields, but what we are hearing and what vegetation health is showing us is that they should be pretty good, maybe a little better than USDA is forecasting today. So they combine those two, and all of a sudden we've got 925 million bushel wheat in stocks. That is up 60% from where we were just 3 years ago. Maybe not quite outright oversupplied, but there is going to be a lot of competition for feed where it exists. And that includes the Western Plains. A lot of those cattle heavy areas have always fed wheat, but now may look to feed wheat more if you've got a very weak hard red market. Hard red stocks probably will be about 400 million bushels in 25-26. That's very high historically. So it's just something else that acts kind of as an anchor to the corn space, is just this, pretty large U.S. wheat crop, and really the lack of production issues, but I think even supply questions in terms of Northern Hemisphere wheat. I mean, we thought wheat might be the one that had some upsides because we were looking at pretty severe drought in places like France, which is one of the largest producing countries on earth. Italy as well, the UK, all pretty decently sized wheat producing countries, but looking at vegetation health, it does not seem like there are any glaring issues. And I know this is not terribly relevant to the U.S. dairy farmer, but what wheat has been harvested in Southern Europe is doing very well. And in places like Romania, I think the idea is for record wheat yields and production there. So European wheat production, and I mention this because it has been forecast to increase by 15 million tons, and we think that is probably the case. Maybe it's 12 million tons, maybe it's 16 million tons, but there will be a lot more wheat in Europe this year. And so Europe will need less corn. European wheat markets will kind of have to find export demand. That does not give a lot of strength to the wheat market. And so what does corn do if that is the case? That's kind of where our heads are at with wheat. Again, in as much as this matters for kind of feed grain price discovery globally, it's a market that's stuck. It is the opposite of something like beef or beef cattle or even the milk space, where you've got a market that's pretty well supplied, prices are deflated, and what you get when that happens is the absence of volatility, which is important to know. I think that's, you can't be terribly bearish of wheat here, despite weather being pretty good in most places of the world. Demand growth pretty lackluster, but we're stuck here. I think the Chicago wheat market, 520, 580 for the next 12 months is a scenario, just because the market can't rally because you got to get rid of the stuff, but it can't break because you're below the cost of production already. But you have a very flat wheat market. This corn kind of joined that at some point, after harvest. And lastly, there's not much to say about the protein meal market. I think it is similar to wheat in that it's not expensively priced. We know stocks are pretty abundant. We're producing a lot of U.S. soy meal, but also the market's clearing excess inventories. And that's always the goal when you enter bearish trends, is what price does it take to kind of balance supply and demand out? And I think, $290 a ton is certainly doing that. We are exporting record amounts of U.S. soybean meal. So I don't think there's really any issue in stocks building unexpectedly because we are exporting so much of it. But I do think the meal market's stuck between $280 and $310 per ton. So it kind of makes sense to buy breaks. I think it's hard for us to be terribly bearish, but also just expect a very dull protein meal market moving forward. So here's kind of what we're left with, and this looks very similar to the way it looked, just 2 weeks ago, in that you've got pretty decent milk feed ratios. And so I think this is something to focus on, maybe as much as the price of cash milk or class 3. I think margins will exist, and I think we kind of want to look for a spot to lock in forward coverage. Again, I think with protein meal, you can do it at any time. You can do it today, 30 days from now, but we do like the ratio where it exists. But even corn, as bearish as the corn outlook sounds because of U.S. weather and larger Brazilian production, we want to communicate, the runway is still between now and about late August. That is when corn almost year in, year out forms an annual low. And we'll revisit all of this again. Is there a Chinese trade deal? What will South America do the following year? What are ethanol margins in the U.S.? And so I do think you got kind of probably a weak corn market, but only until, between August 20th, September 5th, which is not today. There's time left, but the runway is kind of down to weeks, if you think about it. So look for spots. I don't know if that's, 370 cash corn, 360 cash corn, $4 cash corn, but just kind of be prepared. Have it in your mind that, in the next 45, 60 days, we do like these ratios that you only lock those in when you lock in kind of your forward milk sales and your feed costs. So be prepared for that. So that's kind of where we are. I think the next several dairy signals would be all about weather and foreign milk production, but that's still kind of a high level message. We like dairy margins. I think they stay pretty positive, and there is downside risk in feed just because of U.S. weather, if nothing else. So thank you again for your time as always. And if you have any risk management questions in the future, here's my email address. Please do not hesitate to reach out.
Well, Ben, as always, it's truly a pleasure to have you on and to walk us through kind of some of the big picture things that are impacting not only dairy and the agriculture markets, but those markets as well that have an impact on feed and what we're doing as a business. But we've got some questions to go through here. So I'm going to start from the top and we're going to work our way through. The first question reads, given the China whey loss, how does this play on overall long-term dairy export demand and supply? With more milk supply, will this impact prices?
Yeah, I think it's doing it now. I think it's what Class 3 has done makes some amount of sense. It's hard to speak towards. I think China needs whey. I don't think they can get it from our competing markets like, Oceania, Europe. I suspect China comes back as long as we can kind of ease trade tensions, thaw those a little more. But I think in terms of total dairy exports, we kind of have a template, and that's April. It's the loss of whey export demand from China is not enough to offset the value of U.S. dairy exports or even sort of the tonnage as a whole. So I think it's secondary to U.S. cheese and butter being cheap in the global market. So the loss of Chinese demand for whey doesn't alter our long-term milk price forecast, if that makes sense.
I think it does. The next question here, it is 100% $1 million question, but what's your insight on why has butter consumption gone up so much worldwide?
So I don't know. It's a very good question. It's probably the confluence of things. I mean, in the U.S., thinking about just the various health studies that have determined butter is not as bad as we thought it was, 20 years ago. And that was followed by, I think, people changing breakfast eating patterns. All day breakfast at McDonald's, I remember that being hot news. So I think it's just very little things, but when you multiply it by 60% of the world's population, it's a lot of butter. So I think it's, probably comes down to the lack of, or, better messaging on the sort of maybe health benefits of butter. That's been one thing. And then I don't think that even, $4 per pound butter is going to change anyone's eating habits, make them go back to eating the way they were 20 years ago. So consumer preference, I guess, would be the answer to that.
Okay, next question here reads, the inflation report doesn't match the restaurant performance and consumer sentiment, in my opinion. Of the three, which should dairy producers watch closest?
Probably restaurant performance would be the one that we would talk about the most at AgResource. I mean, improving that is a big deal for kind of medium-term food consumption. Think about, I don't want to say food is wasted, but more food disappears when restaurant traffic is higher. And that's what we're all about. Is food demand up? Is it down? Is it stagnant? That's kind of the number one thing that we do. So I think restaurant traffic, restaurant performance is probably top of mind to us since we're in the food space.
Okay, next one here reads, the USDA won't have a July replacement report since that was discontinued, correct?
Correct.
Okay, easy answer on that one. Next question here reads, which will drop first, wet calf prices or utility cull prices?
Mhm. I'd say probably, I don't know. I think they sort of move in tandem together, but wet calf prices, I think, of the two would be the one that drops first, but I suspect none of them drop until September at soonest.
Okay. And Ben, that was our last question that we had for you this afternoon. So as always, thank you so much for your time. We really do appreciate it here and appreciate all the insight that you brought for us this afternoon.
Likewise, always a pleasure and looking forward to do it again in a couple of weeks.
Sounds great. And for those watching, thanks for joining us. If you're ever wondering what else is going on in the world of professional dairy producers besides the Dairy Signal, you can head over to our website. We've got a lot of great programs, including the Your Farm, Your Footprint initiative and Accelerate, which is for agricultural interns this summer. So make sure to check both of those out. But for now, thank you for joining us here today on the Dairy Signal. We'll see you here next week. Bye now.